Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Doug Cruikshank, Managing Partner and Founder at Hark Capital. Doug, it's great to see you. Thank you for your time, and I'm really looking forward to this episode today.
Thanks, Todd, for having me. Me too.
So to kick off, as someone who's been, in and around the fund finance space, for quite some time, the market has clearly taken off the last few years, and it feels like it's at, quite a pace of growth. How much can it keep up this pace, as we're looking into, say, 2, 3, 4 years down the line?
It's a good question. I think actually we can keep up quite a good growth clip here. And the reason I say that is PE continues to be more competitive. And with any market, as it becomes more competitive, you need more tools to keep driving it. And fund finance, NAV lending has really become a permanent asset class now. It really has become a tool that both GPs at PE firms and LPs have recognized as helpful in most circumstances. We can talk a little bit about that later, but something where it can help drive returns for LPs, and it can really solve certain problems that are now occurring or are likely to occur going forward. In short, it provides optionality for private equity firms to help their portfolios. And I think that trend will continue and will continue to grow as we proceed.
How different would you say the market is today than, say, 5, 10 years ago? I mean, obviously the product set has become more sophisticated. There's, non-bank lenders that have moved into the space with the advent of and growth of private credit. How different does this market look today than 5 or 10 years ago?
It's totally different. We were one of the pioneers in this market. And I remember, 10, 12 years ago, we would go out and I'd fly to Chicago or somewhere and have a meeting with a partner for the private equity firm. I'm like, hi, I'm Doug. I've got this product, which then wasn't even called a NAV loan, by the way. It was called kind of a fund guaranteed loan or a fund supported loan, if you didn't want to use the G word. Said, I've got a great idea for you. I can do this thing to provide financing for a portfolio company of yours. And here's what I got. And it's like, I've never heard of that before, number one. I'm not sure I can do it per my LPA. And even if I can, I'm not sure I want to. So it was kind of a hard sales process in the beginning to convince people to adopt a new product when the uses really hadn't been, perfectly, determined. And then I would say maybe 5 years ago, we had modest acceptance. So, some people had heard about it. Yeah, I haven't done one, but one of my buddies I heard did one. COVID really helped us because it showed what can happen when you really have a liquidity drought, and that certain things can occur in the world that you didn't expect. And having another tool to finance it under those circumstances could be really helpful. It was fun doing deals in COVID where we couldn't actually meet with anyone, by the way, but we managed it. And then capital providers, of course, started taking notice of this new product called a NAV loan. And they're like, wait a second, this looks like a pretty good idea. This could be helpful. And so they started doing it as they saw it was potentially attractive to sponsors. And then, of course, more recently, they've been called NAV loans. And as I said, have become a permanent asset class. So it's been really gratifying to see this thing that didn't really exist, particularly in the past, get named and become something that now everybody's talking about. And if you look at the conferences, the FFA conferences and things like that, I mean, it started out tiny and now they're huge in multiple cities. So that's been kind of cool.
So tell us a little bit more about Hark. Where do you guys focus in the market? What does the team look like? And thinking back to when you started the firm, kind of what gave you the impetus? I'm going to start, this venture.
So we started Hark in 2012, and it was basically a reaction to the GFC. So at that time, we noticed that a number of private equity firms had portfolio companies that needed a little bit of TLC. We affectionately refer to them as problem children. So they had great prospects. They were just going through a little bit of a bump, and that little bit of a bump usually required some time, but also some money. And what these firms had in common was two things. Whatever it was that required that additional money was really an equity problem. So it was not something that you could just go to your bank and borrow money to solve. There was some equity risk to it. And the second thing was these funds tended to be out of their investment period. So they didn't have the ability just to call down the equity, the capital from their LPs to solve it. And so they were looking for a solution that could take care of this sort of hangover after the GFC issues in a non-dilutive way. And so we were thinking about that and said, well, it would be great if we could solve that problem. And there are generally two ways of solving equity risk. One is you just get a higher return, you pay yourself for the equity risk. And the other one is to make it not equity risk. So he said, what if we just wave a magic wand and make this one company, equity risk, be debt risk? Because if we could do that, then we could lend money to them in a non-dilutive way. And of course, what we came up with was this idea of a fund level guarantee. So basically, you're diversifying one company equity risk in a multi-company debt risk by putting the assets of the whole fund in play. And it's really just an asset-based loan if you think about it. And the assets, instead of being mortgages or car loans or whatever, they're just the equity positions of a private equity fund. And so that was kind of the germ of an idea that we had. And we went to one of our partners, a big investor at that time who had helped us with other things at my predecessor firm, and said, we have an idea for a new concept fund, and we think this could be particularly apropos given what's going on in the world. What do you think? And they said, yeah, that actually sounds like a good idea. And so off we went to the races, and we raised our very first fund in 2013, and started doing these things that again weren't even called NAV loans before. And we started with a very small team of just three of us, and we've grown that team over time um, to expand the franchise. For Hark, we focus on the lower middle market to answer that question. So people say, well, why did you start in the lower middle market? And I said, well, because we had a really small fund to start with. So that that made it pretty easy to choose. But going forward, we've actively chosen to stay in the lower middle market because we think there are better barriers to entry there. And it's a little less about price and a little bit more about relationships and structure. So that's what we've tried to do along the way.
There's certainly there's been, I'd say some bad press around NAV lending, and it's probably been overblown in terms of the amount of loans and what's been used in some of these stories in terms of distribution. But how well understood is the NAV product today when it comes to LPs?
I would say it's pretty well understood, and that understanding is growing. But you're right, there has been some misunderstanding over time. And if you look back, to like the summer of 24, there was a lot of uncertainty in the market because there had been a couple of dividend deals, which I think frankly surprised LPs and not in a positive way. And there was a lot of press around these new things that were gaming DPI or were gaming carry, and they were really evil, and you shouldn't be doing them just categorically. And what happened was, of course, you sell more papers with negative news. It's not particularly interesting to say, financial sponsor does NAV loan, portfolio is worth more. Like no one cares. So you want to have something a little bit more, spicy to talk about. And at the same time, ELPA was looking at this. So everybody was very interested in what ELPA was going to say about this new emerging asset class. Um, and I would say there was, one other thing going on, which was at that time, everybody was very optimistic that the M&A market would become unstuck, that uncertainty was going away, and the problems that PE was facing were just short term. And so there wasn't a lot of focus on NAV loans because people didn't think they were going to need them. There was concern because ILPA hadn't given their view, and there was negative press. So what happened? Well, the first thing is that ILPA came out with guidance and said, um, inherently, there's nothing wrong with these. Just use them for the right purpose. The way I like to describe it is NAV financing is just a tool. Tool could be used for good or evil. Think of a hammer. You can build a house with a hammer. You can also whack someone in the head with a hammer. So, do good, don't do evil, don't surprise your LPs, be a creative portfolio, sort of, motherhood and apple pie kind of stuff. And so everybody sort of calmed down and said, great, that's helpful. Um, the second thing was the M&A market did not, in fact, open up. And so there was a real need for these things. And so what is it? Necessity is the mother of invention, as they say. So both GPs and LPs said, well, wait a second, maybe these things can be helpful in certain circumstances. And what was left basically was more clarity on when NAV loans, when fund financing should be used. And it should be used, as I said, to improve portfolio returns, not to game something that wouldn't happen otherwise. And one of the analogies I like to use about this is fund finance is just like another wave coming across the sea, and there have been previous waves. For example, capital call lines. When capital call lines first came out, people were horrified. I can't believe you're going to put leverage on the fund. I mean, that's crazy talk. We can't do that. And now, of course, everyone has one. And like, of course, we would have it. That makes all the sense in the world. But there have been other ones. So CVs, which were previously called fund restructurings and were used when a fund couldn't quite exit the things in the time frame they wanted to, and they were considered bad. Now, obviously, there's a little controversy around them too, but in fact, again, it's just a tool, and used in the right way, it can be really helpful to GPs and LPs. And if you go back far enough, you can actually look at the secondary market in PE, which never used to exist. And people said, well, if you're an LP and you're selling a position to GP, there must be something wrong with the GP, right? It was an indictment against that GP. And then, of course, later on, people said, well, no, that's not true at all. Just liquidity is a good thing in the market, and there should be some, healthy trading. And so this is just another example of a relatively new product emerging and filling an important need in the market.
What would you say excites you most about where this space is heading?
Um, I just love the fact that we're fulfilling this need. So nature abhors a vacuum, as they say, and there was a vacuum in the middle-aged portion of a fund, usually, so sort of the 6 to 9 year portion of a fund life. And there hadn't been really great tools to deal with that desert space. And we didn't really need the tools because PE was pretty successful in getting into companies and getting out of them with pretty good regularity. But then, of course, when all the bumps started occurring in the world, it wasn't quite as easy, and so there was a drought. And I love the fact that this new thing that didn't really exist 10 years ago has come in, started filling the market. Helping solve needs. And it's just sort of exciting to be part of it. I imagine, it's like what direct lending must have been in its early days too. So I really like that. And it just feels like um, the whole industry is a little entrepreneurial, not as much as it used to be 5 years ago, but it still feels a little bit cutting edge, and that's kind of fun.
On the flip side, what concerns you most about where the space might be heading?
Um, whenever when I started doing this after 20 plus years and I left investment banking, people said, Doug, is it a good idea to do this thing that no one's ever heard of? A new concept fund. I was like, I don't know yet. I'm going to have to tell you in 2 years. Um, it turns out it was a pretty good idea. And that was the good news. The bad news is it was a pretty good idea. So more people have come into the space.
Yeah.
It's gotten more competitive. Um, and whenever that happens, sometimes you get, I'll call them tourists who haven't done it a lot, but say, hey, sounds like a pretty cool thing. I think I can do that. And sometimes they really bring down the market. And that could be in terms of pricing or structure. And they're just doing things that, maybe aren't as thoughtful as we'd like to see. So that bothers me a little bit. But again, I think it's just a natural part of the maturation process of an asset class.
What about, and especially lately, we've been talking to a lot of folks, um, and there certainly is a concern about, I guess for lack of a better term, kind of the oxygen being sucked up, the capital being sucked up by those at the top, and too much ultimately getting concentrated at the top. Do you see that as a concern? Are smaller funds, in some ways being left behind? I know you mentioned where you continue to focus, which is the lower middle market. As someone in that space, is this a concern, that you have over the next few years as some of these large firms continue to, gobble up capital and gobble up oxygen?
Well, if you're talking about gobbling it up on the PE side, it's actually an opportunity for us.
Okay.
So, the old expression they used to say is you don't get fired for investing in IBM, I think is translated to you don't get fired for investing in Apollo or Blackstone or KKR.
Yeah.
And so you're right. I mean, a lot of the money that's going into PE right now is going to the top guys. And in tough fundraising environments, if you're a pension manager, an insurance company, or any investor, there's going to be a natural bias, to pick a really blue chip name. And that's an opportunity for us because in the lower middle market, it's harder to get the money. And so they have more of a need to extend their runway, if you will, for their current funds. And that's where NAV loans can come into play. It also means you have to be careful, right? Because not everybody's going to get to their next fund. Not everybody's going to be successful.
Yeah.
Whereas, Apollo is probably going to make it, I think, at this point. um, and so um,
I think we might be in different issues
I
if
think
that's
that's
not the
right. I think we have a
case.
lot bigger problems. Um,
Yeah.
so it's an opportunity for us, I think, in the lower middle market to do that. So I see that actually as a positive.
What areas, within the broader fund finance ecosystem do you think are most underdeveloped today?
Um, I think as with any asset class, the way I describe it is you can choose your own risk adventure. So you can invest in a really strong, dividend paying stock, or you can invest in early stage venture capital if you're in equities. If you're in debt, you can invest in really safe stuff. You can invest in really gamey stuff. And and that again is nature abhorring a vacuum. Everybody, water finds its level, as they say. So everybody as an investor gravitates towards what risk return profile they'd like to achieve. And that presents opportunities across fund finance, whether it's, what we do in the lower middle market, what someone else does in the upper middle market, whether it's really, gamey, high risk stuff with very concentrated portfolios for venture capital, or whether it's, lending, money to a secondary fund. You can choose where you want to be. Um, and I think that that's great. And it provides, opportunity for everybody to do that. I think certain areas that are underserved are probably or developing are CVs. As that market has really grown, people are trying to find new creative ways to finance things and to basically make them more more valuable, if you will, if you're right. And I think certain industries, real estate's a perfect example. It's not something we like to focus on, but there's certainly an opportunity there because they need money.
Yeah.
And if you can do it correctly and have some expertise, that could be fine. And then I would say more earlier stage funds like VC or even growth equity, right? It's different doing an av loan for a mature PE fund whose companies have revenue and EBITDA. It's another thing doing it
Yeah.
for an early stage VC fund. So these are all areas, that are developing. And again, people are choosing, their venture in terms of how they want to play there.
Yeah. There's certainly been a huge amount of growth within the private credit space and private credit funds, coming into fund finance in bigger ways as well. And so, what are your thoughts on, so private credit funds are borrowers, they're lenders, insurers are borrowers, they're lenders, and it feels like there's a lot of like circular capital going between these firms, as at least from the outside looking in. How do you view that, kind of potential conflict of interest with, at least from my perspective, seems to be a bit of a conflict of interest?
So Todd, some would call that synergies. Um, um, I'm just joking. No, I understand your point. And anytime there's interconnectedness, people like to point back, to '08 or whatever and say this is one of the reasons, that whole thing happened. What I would say is there's absolutely interconnectedness, right? There's just no doubt about it. On the other hand, there are a lot more players,
Yeah.
right? So there is, or there should be more resilience because there are more players and it's less concentrated. The other thing I would say is that, at least in terms of, of fund financing, that's not the riskiest part of the market, right? Like that's not the place that you would think that, um, you'd find a surprise blow up somewhere, right? It's not like CDO squared kind of thing. And so that feels okay to me. And again, from the dial your own risk adventure perspective, if you're doing a NAV loan to a broadly diversified credit fund, sure, a credit fund could run into some issues, but if you're being prudent about it, the chances of that loan itself going bad are probably relatively low. Um, and so just because someone is doing that, um, in addition to other things, doesn't necessarily mean there's more systemic risk. So I think with all of these things, there will be people who do dumb things, who overextend, do things they shouldn't, and that'll be a problem for them. But in general, I think the diversity of sources here, and what's going on, is not something that I stay up at night worrying about.
What about on, kind of the structural innovation side? I mean, I was reading a list the other day. I think it was like 19 different products in fund finance. Some of them funky I've never heard of, and they're probably niche in their in terms of the size and amount that might do them. But have what are your thoughts on kind of where some of the structuring is going? There's certainly a lot more structured finance that have come into fund finance the last couple of years. Are you seeing anything particularly interesting today, or where that might be heading?
I mean, my view structurally in general is you're just trying to make a love connection between a provider of capital, right? And someone who's deploying it, right? So, for example, if you take evergreen structures, you're trying to make a love connection between a fund that has an evergreen structure and retail investors,
Yeah,
right? So the evergreen is just trying to solve that connection. Um, it's the same thing with a rated insurance feeder, right? You're trying to find an attractive way of insurance companies to do it. And so I think those are a couple of things that are going on. You see CFOs, collateralized fund obligations, where you're putting oftentimes multiple products, debt and equity into a vehicle and basically tranching out the returns and providing a profile along the way, which is no different conceptually than like a CLO, right?
yeah.
All you're doing is you're divvying up the risk, return profiles. You're making them plural, right? So you can maximize, the amount of capital you can raise and minimize the cost. So I think that's perfectly natural. It happens all across finance. And I think some of these new structures, are helpful and creative.
So we have a couple of questions left before we get to our fun questions to end the episode. But we touched on it earlier in terms of why you started Hark. But I'd be curious, kind of what led you to kind of take the leap to become a founder? Like is entrepreneurship in the family? Was it just, you think this area of the market you thought needed a potential product like this? Was there anything else that made you say, I'm going to take the leap to become an entrepreneur?
There's absolutely none in the family. I had no idea whether I could do this. But I was just kind of tired of the whole institutional big firm thing of investment banking. Loved what I had done previously, but just felt it was time to try something new. And really wanted to challenge myself, like sort of a personal growth challenge to see whether, this might work. Um, and honestly, it was pretty scary, because I hadn't done it before. And
Yeah,
I was used to wherever I was in investment banking, whether you're an associate or an MD, you kind of know what you're doing more or less, right? There's kind of a box that you're in, and you kind of know how the rules in the box work. And there's a department for things outside of your box that you can go to. And when you start something up, the box is the whole thing. There are no other departments, and there aren't really a lot of people to talk to figure anything out. Um,
yeah,
and so, when I first started doing it, when I first started doing it, I was kind of scared because you have to make decisions, like because you don't go anywhere if you don't make decisions. And what was
yeah.
scary about it was I didn't really, have a lot of basis for a lot of those decisions. And I don't like being that way. Like I like knowing what I'm doing, as we all do. And so, I had to start making decisions because there was no other choice. And fortunately, my decisions did, not end in a world cataclysm. The world survived, even if I didn't make perfectly right decisions. And I
Yeah,
started getting confidence, that the world wouldn't end if I made a slightly bad decision, but also most importantly, that I could make decisions without 100% information. And that was the game changer, right? And that's really what empowers you, I think, as an entrepreneur, is realizing you're never going to have 100% of the info and you still have to make the decision and it'll probably be okay. And that was really empowering and really cool. And one of the things that, that I like about it.
Would you say that's the biggest lesson, or have there been another lesson that you'd say is the biggest lesson you've learned as an entrepreneur these last, 13, 14 years since you started?
I would say it's sort of related to that, which is you have to solve problems, not just identify them, because there is no, problem solving department. You own every
Yeah.
decision. You got to do your best to figure out the right, answer without complete information. And you might not have, 20 reps of that. So that's kind of, I think, one of the biggest lessons is focus on solving problems, not just identifying them, because identifying them isn't enough. And when we, as a team, talk about things, I say whenever a more junior person comes to a more senior person with something, never just come with a problem. Never say, "Hey, Todd, the problem is," and then that's it. There should always be at least some attempt to have a solution. You don't have to be right every time, but you
Yeah.
have to have the mindset that when you arrive in a meeting, you've thought about it because it's all about problem solving. So that would be kind of the lesson I've learned. And I think people really embrace because, again, it empowers you. It makes you feel like you're part of the action because you are.
So a few fun questions
Sure.
as we look to wrap up here. Favorite sports team and or hobby?
So I actually like playing sports more than I like watching them. I've had a long racket sports background, so I played a lot of squash in college and played tennis and paddle and pickle and a bunch of things. It's currently paddle season right now, so that's always fun in the winter in the Northeast. I'm also a skier, which is coming up on that season, and I'm
Yep.
working on my golf game. So I will say that is my next personal frustration challenge to address. Um,
Isn't it all
oh
golf
my
is all frustration.
Oh my gosh. And my new hobby, so I don't know if this is a full-fledged hobby, but I just found this out a couple of days ago. We've been using Copilot in Outlook. And I had this thing which
Interesting.
was a really boring email. I won't say who it's from to protect the innocent, but it was from an institute. It was super boring. And I wanted to forward to someone. I hit summarize and it said, well, do you want, short? Do you want long? Do you want formal? Do you want colloquial? And then there was this other button that said poem. So I hit poem and it creates this really cool, like, 6 stanzas worth of poetry summarizing this otherwise incredibly boring thing. So I'm not sure that that's going to generate a whole lot more return for our fund investors. On the other hand, I thought it was incredibly clever. And then I got, 4 replies from everybody replying back in poetry. So if anybody's looking to kill a few minutes for a lark, that would be worth trying.
One surprising thing about yourself.
I was a religion major in college.
Hmm,
I didn't know what a
interesting.
debit or credit was when I graduated from college.
Wow. That's fascinating. What made you go away from it uh, after college?
Well, when I was a sophomore in college, I thought I was going to be economics major, and I thought I might spend my career doing some finance stuff. But I took a course in comparative religion, and I thought it was fascinating learning about all these other world religions and thinking about this force that moved virtually everybody in the planet in some way, and yet oftentimes the beliefs were mutually exclusive. And that
Yeah.
just fascinated me, sort of the philosophy of it. And what I would say, um, in the intervening career between then and now, I have never lacked for an interesting conversation, whether that's in a business meeting or a cocktail party or anything. Everybody has something to say about religion, even if you're not religious. That in and of itself is saying something. And
Yep.
so it provides a great way to get to know people and to really personalize things. Um, you just have to be a little bit careful, like talking about politics.
Of course. One book you'd recommend reading.
Um, I would recommend a book called Nuclear War, which is not a particularly upbeat book, I'm afraid, but it's by Annie Jacobson. And if anybody's seen the recent Netflix movie, A House of Dynamite, it's quite
Oh, I
good.
just finished it. Just
So
finished it.
if you like that, read Nuclear War. It is basically about a scenario where I'm not spoiling anything because it happens in the beginning. North Korea launches a missile, And what's interesting about it is it's kind of fiction, but kind of not, because she's interviewed a lot of top people in our country and others and analyzed the protocols of what happens,
Yeah.
right? When something like that occurs and the path it takes. And she brings up statistics like how many intercept missiles we have. And it's a really fascinating read and gives you a sense of the real difficulties of what's going on here and how just mutual deterrence isn't quite as easy as it sounds.
Interesting. I'll have to check it out. Most exciting part of your job.
I would say figuring out how to help people grow in their job. So I always say the finance isn't that hard, it's the people, which is probably true in any
Yeah, that's true.
profession. But I mean that in a positive way, in that everybody's complex. Everybody has a set of skills and career goals. And what's fun for me is helping unlock the puzzle. How do I make this person really excel? How can I look at their skill set maybe in a different way to accelerate their growth, to make their career desires come through? So I literally look at that as an ongoing personal challenge. And one, as I say to people as a manager, I don't just manage you, upon you. It's a mutual thing. You have to own your career too. And when you work with someone in that kind of mentor-mentee fashion, where there's joint ownership, but clearly the mentor cares, it's a great way of building relationships. And I think it's very satisfying, at least for me, to be part of that.
And then final question, one prediction for the next 12 months.
Um, well, I think there's going to be a stock market correction here. I know everybody's talking about a bubble. On the other hand, the market generally has been going up and the economy's been pretty strong. But the reason I mention this is because everybody talks about the fundraising market being really difficult and PE being challenging right now. And that's generally been true, but it's been in the absence of a denominator effect. And so if we get a downturn here that's at all prolonged, it could just get worse. And I think
Yeah.
there's a decent likelihood that happens. The good news is I think that's generally positive for fund finance.
Well, that's a perfect place to end it. Positivity for fund finance. Doug, I really appreciate you coming on the show. It's been great to have this conversation with you. Continued success to you and the team, and look forward to seeing you again soon.
Todd, thank you very much for having me. It's been a pleasure speaking with you.
Thank you.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.